Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. And today we're going to rip through Twitter, see what people are sharing like we normally do in the morning sessions. I'm going to interject my financial opinions. Most likely it's going to be related to wealth building, financial topics, and or commodities. So let's dive in here. Let's see what's going on, what people are sharing, and I'm going to interject and sprinkle in my opinions as we go. So if you want to follow me, it's at Finance Grow Finance. And if you want to join our community, finding-value.com, you can use the discount as coupon code if you'd like to join. And that's where we talk about individual companies, individual sectors, all stuff like that. So we've got Moop here, the original Moop, not the later one. This is the OG. Longtime fan and follower, much thanks for the good work. Question, lumber looks like it's starting to spike, climb. Thoughts on the chart, and is it a good leading indicator of future inflation? It is. It is a indicator. You can also use the home builders as an indicator as well. So here's lumber. I just yanked it up. It looks like this chart only goes back to 2022, but it's been in a downtrend, and we recently have broken that downtrend to the upside, and we've got a nice little bullish engulfing here. So that does look like it wants to go higher. We can also look at things like Lennar Corp. Lennar Corp is a home builder. It's a large home builder. I put on logarithmic. Big long-term chart. This was your peaking pattern. It peaked in 2005. The housing starts did. We had a crash in 2008. This is a leader of potential chaos, at least chaos that is derived from the housing market. And if you look on the right-hand side, we broke out of this consolidation and we've been running to the upside. I'm not stating that this is just going to go straight higher. You can have pullbacks as we go. Just like today, we had a little bit of a stronger selling pressure day and higher interest rates, et cetera, et cetera. But we're in an expansion phase of real estate. That is undeniable. And I don't understand how people do not, I don't know why they can't come to grips with this. I mean, all of the data that I look at points to an expansion phase of real estate. Low existing inventory, all-time lows for occupancy rates. You know, unoccupied houses is at all-time lows. Like, what other data do you need? And then what people do is they create a narrative based off of short-term price movements. Completely and utterly wrong, in my opinion. If you've got a trend, much like this one, and it's intact, ride the trend, and just wait it out. I mean, this thing's been trending the entire time higher. And basically, it's, do you have a growing population, and are they one of the the leading builders in the industry? The answer is yes. Just stick with it. So the home builders are looking good. Lumber's looking strong. We're in an expansionary phase of real estate. We're underbuilt by, I don't know, 3 to 7 million homes, depending on what data you look at. It's all underbuilt. And it's family formations in relationship to homes that were built for those families, or the lack of homes that we don't have. And all of the home builders that I follow, DR Horton's another big one. That's basically all up at all-time highs. They all point to the same thing. So I don't need news. I don't need other people to look at background information where, oh, well, we've built all these homes that, there's never been more homes per capita than ever, as today. I'm like, well, that's great, but they're not in existing inventory. They're not for sale. Like that's like saying we've never had more cans of corn purchased, and we want to buy a bunch more corn, but there's no corn in any of the stores. But everyone says that the inventories have never been more full in people's homes of canned of corn. And it's like, well, that doesn't do anyone any good if all of the cans of corn are sitting in people's shelves at their house and not on the shelves at the grocery store that I can actually purchase. So if people have homes and they've got multiple homes and they're not selling their houses, and your vacancy rate is at the lowest like ever, I don't understand their I don't understand their argument. Then they'll pull the unemployment card where they're going to say, well, when people become unemployed, there will in the future be this gigantic bubble in housing. But does history bear that? No, history does not bear that. We've had unemployment rates go up with house prices. House house Housing is priced off of supply and demand. Period. Period. So how much supply and how much demand do we have at interest rates that are at where they are at today? That is the question. And if you do not build inventory of existing homes, you are in a relatively balanced market. And in a relatively balanced market with low inventory that is not growing, house prices are going to continue to go up. I don't know why that's so hard to figure out. It's like, I mean, I hate to say it, guys, but learning economics is a billion times easier than trying to learn fluid dynamics or thermodynamics. It is a billion times easier. It's like I just saw here recently, and I'm just kind of going off on a tangent a little bit, but I saw that what's her name? Lynn Alden was going to do like a speech. I think it was at like Princeton or something. And the thing that occurred to me is, why do we need engineers to teach finance people finance? It's like, oh my God, like I don't know. I just thought that was real interesting. But yeah, lumber looks good, and it generally is a leading indicator of inflation. You might as well just follow housing starts. You can cut out the lumber portion. Lumber is was highly impacted in 2020. It is supply and demand, and they literally shut down all of the supply, which has never happened before. It's kind of like idling a car at stop and then asking if your radiator can support the power that the engine has. The problem is the radiator only works when you're moving. It's the fan that you're testing when you're at a stop. So lumber, it's great when everything's stable, and then when demand exceeds supply, lumber prices go up, and that's generally an indication that demand is increasing faster than supply. But we stopped supply, and I think supply got all sorts of messed up in 2020, 2021, 2022. I mean, I think it's probably a good indicator still, but there was a large shock to a lot of these commodities from 2020. US versus Chinese equities, two diverging narratives here, double top here and a double bottom here. Yeah, I totally agree with that. And the driver of this is going to be an inflation, an expansionary phase of real estate. You're going to see the dollar drop at some point. It's going to push emerging markets higher. China just went through a gigantic deleveraging event in their housing market, and we're at a double top in the S&P 500. I do think that's going to occur, but is the top exactly now? I don't know if there's. I don't know how much more is left in the tank. There could be more. There could be a lot more. We could even go up here for all I know. But the valuations over there and the market conditions are not going to support an S&P 500 bull market forever. I think we're going to get a sideways move for a period of time when commodities really start to rip under an expansionary phase of real estate. That has occurred every single time in history, going back to the 20s, 30s, of when we had commodity bull markets in those expansionary phases of real estate. Every time. Strong finish for UEC, which closed up 3.87%. Nice big bullish engulfing there. Looks like it could go higher here, but we'll see if there's follow through. This is only one stock in a group of stocks, and all of the stocks don't possess gigantic bullish engulfings, but it looks good, and we'll see what occurs. Some people look at the stochastics or relative strength indicator like up here, and they'll say, oh, it's just overdone. This can stay overdone for years, guys. I've seen stocks where RSIs have been overbought for years, like very, very strong stocks. They basically go up above the 50-day moving average and just stay above the 50-day the entire time for years. So I don't I'm not going to be in the camp where they're like, oh, it's overbought in the short term. What am I going to do about it? I'm not going to sell. I'm going to hold on. And if it's a bull market with the winds at our back, I'm just going to stick in it. I'm going to stay in it. High volatility. Shale gas plays are beginning to look like a graveyard. Expectations for future U.S. shale gas production may be too high, and reserves may be overstated. I wanted to jump into this real quick. So what he's got here, I'm just going to touch on the graph he's got. Drain America first, shale gas plays have begun to decline as U.S. becomes biggest world LNG exporter. And this is what we've got for the different shale plays here. And in his opinion, they think that Art thinks that they're beginning to decline in production. So if we come on down, shale gas accounts for 82% of U.S. dry gas production. There's your shale in the red, and then total gas on above that. This is more conventional, and this is shale. So coming on down, we look at net LNG exports expected to increase 6.4 billion cubic feet per day by 2030, and another 7.1 billion cubic feet per day by 2035. Total net exports to increase 15 billion cubic feet by 2035 from 13 to 29 billion cubic feet. 13 to 29, that's a double. A double. And that is crazy, guys, because here we are. This is 2023, 13 to 29. That's over a double. It's almost a triple. Now, he's wondering, do we actually have the natural gas to export that amount? So we go down and we look. These are the different shale gas plays: the Bakken, the Anadarko, Permian, Eagle Ford, Haynesville, Marcellus, and Utica is up on the east. Those are our shale plays. So we come on down and we look at Marcellus shale gas production has stopped increasing despite more producing wells. We're going up and up and up, and we're starting to hit a peak. Now, here's another thing to think about. The price of natural gas also matters. And we've been pretty low these past few, 6 months to a year. So this may have an impact on the gas production, as maybe they are throttling back production. I don't know that, but that is something to think about because we've had very low prices. If this was under a really large increasing price environment, I would say, yeah, it's done. But since the price of natural gas has declined over this time, and so has the production, I'm not so quick to say that the wells going up are 100% correlated to the decline of this, because we've also had a decline in pricing. Utica shale gas production, now this one looks like it's definitely in decline. Wells continue to go up. We can see a double top, and then we're coming on down. So I don't know if this is going to reverse to the upside, but this definitely looks a little bit worse, even when pricing went way up in 2020 and 2021. So that looks pretty rough, and that looks like a decline. This one, I would say I don't know yet, Marcellus. We've got Haynesville. Haynesville gas production has stopped increasing despite more wells. We've got that, but I mean, what happened here though? That was another decline. So, and you could see that the wells kind of tapered off, and then we picked back up production. So I don't know. If the data was turning over at the same time that the natural gas prices were going up, I would say definitely it has peaked. But I'm going to hold my judgment for these and say that we don't know if it's peaked or not. Because gas prices have fallen, and maybe they're pulling back on production for some reason. Haynesville shale production rates for 2021 to 2023, horizontal wells are already lower than the wells with first production in 2018-2020. So this is called high grading, or they're drilling their better tier assets, tier 1, tier 2, tier 3. I know there's tier 1 and 2. I don't know if there's tier 3, but it produces, and then it has a decline rate. And then you add up all of these. If you notice 2023, 2022, you can see that the decline rates are faster with the wells that they've drilled recently. So either technology is sucking it out faster, increasing the decline rates, or the resource itself is of lower grade or smaller, whatever it is. But we can see it in the data here that we are getting less productivity out of the wells, and less overall, it looks like, because of the area under the curve here. And what I would say there is this, I think, it doesn't matter what the price of natural gas is. This is the fact that when they drill wells, they're going to try to get whatever they can out of it. And it is declining, period, in Haynesville at least. Coming on down, this is your Haynesville wells drilled in 2021 was minus 3.6 billion cubic feet less than for wells in 2019. So this is your total return. Energy, I can't remember what EUR is. It's the total whatever recovery of the well. For wells drilled in 2022, it was down 31% less than for wells in 2019. 31% less on your total return of it, and that's what we've got for nat gas. So coming on down, it says finding this is for me. Look at the wild volatility in the stock price for this company in the early 2000s. I recall a video you made showing the volatility of some companies, asking your audience if they were able to hold on for the duration of the bull run. This one would be tough. Now, another thing to think about is you're going to have to know the companies you own. Like you're going to have conviction of the companies because these pullbacks that you get 30, 40, 50% pullbacks as we go up in this big bull market, they're going to be real, they're going to be felt, and it's going to be emotional for people holding on to it. So you need to know what the heck your company you're holding. I don't really go into these small companies. I don't know about Hudbay. It's 2.6 billion market cap, but some of these small companies, not Hudbay. I'm just small companies in general that are juniors. They don't have a lot of money. They're going to dilute you to death. I don't have a lot of conviction in those. I don't want to hold them. I want to hold stuff that makes a ton of cash, that pays me a bunch, and I know that they can grow production out in the future. That's where I get my conviction. And then I get my conviction by looking at the natural gas data, like I just did with you guys earlier. That's where I get my conviction. It's like, I think we're getting close to a pretty tight squeeze. Now, here's another thing that people aren't thinking about. If uranium gets super tight and there's really no supply of it, and then, I was listening to some other podcasts or whatever, and they're like, where's this going to come from? What if that's going to add to natural gas demand? The extra swing production is all natural gas. And if natural gas is having problems on the supply side, oh my God, we're gonna moonshot some of these to the upside. If you can be a patient investor, you buy the best quality assets in the world. They can grow production during a time where maybe we struggle over the next 5 to 10 years, and maybe we're really going to have to push for something that is, either more uranium, nuclear uranium fission, or go to something else. I don't know. AI, okay, so this is artificial intelligence. I want to touch on artificial intelligence. It says AI is running head on with a massive electricity consumption. So we go in here, it says artificial intelligence, including systems like GPT-3, consume massive amounts of electricity compared to entire nations and is expected to use 3.5% of global electricity by 2030. OpenAI CEO Sam Altman highlights the urgent need for energy breakthroughs, particularly in carbon-free energy production like fusion, to meet AI's growing power requirements. While AI's energy consumption poses environmental concerns, it also plays a crucial role in renewable energy forecasting, smart grids, and other decarbonization efforts. Now, my thing is, it's like, this thing's we're going to get AI going. If everyone starts transferring to electric vehicles, I mean, what's this grid going to look like? I mean, are we going to torch this thing on fire? Are we going to try to send so much electricity through that this thing's just going to fall apart? I mean, what's the plan here, guys? Now, here's another thing I want to read. It says, just this week, OpenAI Chief Executive Sam Altman spoke to the fact that artificial intelligence is rushing headfirst toward a brick wall. While the technology continues to spread and advance at a rapid clip, there's no plan for how its operations will continue to secure enough energy going forward. There's no way to get there without a breakthrough, he said on Tuesday at Bloomberg event on the sidelines of the World Economic Forum's annual meeting. But he said there's a light at the end of the tunnel, and it lies in the research and development of carbon-free energy production, in particular, Altman says that the energy puzzle facing the future of AI motivates us to go invest more in fusion. Now, fusion has been, it's like it's always 30, 40, 50 years away. I don't know how much closer we are to making steps towards fusion. I don't know, but all I can say is this: the swing producer is natural gas. And if we're running a brick wall, if we're going to hit a brick wall based off of power and energy consumption, and we're seeing power burn and nat gas really step it up, and if we get a peak in some of these shales, guys, nat gas is completely mispriced for where we are. I know inventories are high at the moment, and I know that weather has been on the right side. It's been on the warm side to keep inventory levels on the bearish side of things. But I mean, if we get cold weather, and this is what's coming out in the future, and the shales are kind of slowing down, this seems kind of interesting. It seems very interesting setup here. I'm long nat gas. I'm going to stay long. I'm going to continue to buy when things are cheap, and they are cheap. I already went over that and these here. I was just sharing that for everybody. Martin says, we don't need commodities anymore, but the world can't live without NVIDIA in terms of AI. Bloomberg, so commodities are sending a warning. A ratio of the NASDAQ 100 and the Bloomberg Commodity Spot Index puts tech at its loftiest versus raw materials since the dot-com boom and bust. While they may seem unusual, to compare high-tech and commodity indexes are both expressions of the real world. And we can't do without literal stuff. This is, guys, we're getting close, I think, to a peak. This section here is this section here. And I think we had a detour in 2020 that brought us lower. And this ultimate peak will be the ultimate peak here. So this sideways action is here. That is, so basically it's wave one. Wave three, wave four comes after this sideways motion. We had a detour in 2020, and then we're ripping up, and I think we'll put in a final peak, much like this peak here. And then we're going to go into some big decline. The decline, I think, will be caused by a commodity bull market in an expansion phase of real estate, which exactly occurred in 98, 99 was the beginning of that. 98, 99 was when commodities were cheap to stocks. It started the bull market. Interest rates went up, and all this stuff got pricked. And right now, I think we're going through something like that. We'll see. That's my guess. And don't hold me to it because it's just a guess. I already went over that. So copper countdown to deficit. The copper market this year is set to be on the tightest state since 2021. It's got an anticipated 428,000 ton deficit set against just 260,000 tons of current visible stock. That's your fundamental data, guys. Match the technicals to the fundamental data. The market has suffered a supply shock over the past quarter from a series of mine supply downgrades, reducing expected growth this year by 60% from expectations in mid-23, which will in turn increasingly bind a previously unyielding refined supply dynamic. This will be set against a resilient, if unspectacular, global demand environment as green channels ultimately exert more aggregate influence over a rate easing induced troughing in cyclical channels. Their ultimate target, we continue to target copper to $10,000 a ton on a 12-month basis. Very bullish. We're coming into, I think, a big move in copper. And I know some people ask me about what copper stocks on the diversified miners. I'll come with that information on the midweek update that we do tomorrow. I'll let you guys know my opinions there. Coming on down. Oh, looks like I got moved over there. Coming on down. Coming down faster. Okay, there we go. Oil. So here's Rick Rule. Oil companies are being priced as if Al Gore, Biden, and Trudeau are right, which is to say peak oil demand will occur in 2030. That is downright stupid, says Rick Rule rhetoric. One thing I'll say as well is if we get a supply crunch in uranium, I think it's going to spill over into natural gas, and I think that natural gas is going to spill over into oil. And I'm not convinced that oil is going to go much higher either. I think we are going to have the largest drilling boom ahead of us that we're going to see in a very long time. Like we're at the beginning of a energy service boom because when the prices go up, there's going to be a delay when everything kind of moves, and we're going to have to drill like hell. I mean, we are going to have to drill like no other. So I think that energy service companies are another good play here, along with the exploration production companies that can grow production into the future. I'm so bullish on oil and nat gas and all of these fossil fuels that already have the infrastructure in place and that we're already using. I mean, just think of it this way. Everybody thinks that the trajectory of EVs are just going to keep going. But at the same time, we've got artificial intelligence and EVs growing at the same time, which is going to really hurt our grid. But that's also at the same time that copper is going to run into deficits. And you're looking at this like, okay, so if you can't really grow the grid as fast as you want because copper deficits, and then you can't grow maybe fission as fast because you've got uranium deficits, what are we going to do? We're going to burn a lot more natural gas. We're going to burn a lot more oil. We're going to burn the crap out of this. That's the way that I view it. And if we're peaking in production of oil and nat gas, we got some problems here, boys. Prices are going to go way higher. I think it will also impact yields and precious metals to the upside. Yields will go up, and I think precious metals will eventually go up too because people are going to worry about the bond market because energy is the backing of bonds and our currencies. It's a dynamic problem. I don't know if I have it nailed down right. I'm just giving you a potential outcome. And if we get really cold weather at the same time, I mean, you could see natural gas spike to some ridiculous level. But yeah, it's okay right now. Weather has been we've been on the correct side of weather to keep natural gas inventories kind of high. But that power burn in natural gas just keeps relentlessly going up. The recession that everyone expected but never happened, these were all in 2022 and 2023. These were 2022. And Jamie Dimon warns U.S. likely to tip into recession in 6 to 9 months. October 21st, 2022. Global recession could last until spring of 2024. Batten down the hatches. Bezos' latest business titan to warn about a recession, 2022, etc. Another thing to think about is maybe we did go through recession, but the money printing and fiscal spending, hit hit it in a way that was nominally. Maybe we already went through it. That's another way to think about it. Here's global oil inventories nearing a 6-year low and falling, counter seasonally bullish. So here's the arrow there of where we're at, and we're basically at the lowest inventory level over the past 5 years. And this is for onshore and oil on water. This is all of it combined. We're sucking down our inventory, guys. And I still don't know how oil prices are this low. Like it is low. We've got all this demand coming from AI, from the power generation, electricity. We've got a weird setup going on where we've got a lot of demand for electricity and a lot of supply constraints. So I think that's going to creep over into oil too, because if we can't adopt electrical solutions as fast as what people think, because of copper and transmission lines and potentially aluminum. There's all these different things that if we can't get the grids up, well, then what are we going to do? We're going to burn more oil. That's what we're going to do. And more natural gas to be the buffer of the whole system. And then, of course, with all of that, Berkshire Hathaway's share of Occidental Petroleum hits 34%. We know where our boy Buffett's doing. He's going to buy a bunch of oil companies and nat gas. That's what he's doing. And that's what I would be doing too. But that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. That's my take on what's going on today. I'm getting super bullish on oil, well, I've been bullish. I've been bullish on oil, nat gas for a long time, and uranium. I just hope uranium can provide the supply that to get nuclear up and running. I just hope it can. Do I think it can? No, I don't think it can. I think we're going to get supply. There's going to be supply gaps. I think it's going to put tremendous pressure on natural gas. That's what I ultimately think it's going to do. It's just going to transfer pressure to somewhere else. While uranium takes off and uranium goes ballistic and the price goes up, I think it's going to transfer to natural gas and oil. Oil is going to also be under pressure. And if we get on the wrong side of weather, if we get a really cold winter where it sucks down inventory, we're going to see natural gas price spike. We're going to see coal spike. All the energy stuff's going to spike again, and we're going to go through another large inflationary wave. And this was all basically what Colin Campbell has said. If after you hit a peak production in nat gas and or oil, you're going to get these big peaks and then a crash, peak, crash, peak, crash. And you're going to do that for however many years. But yeah, that's what I've got for today. We'll catch you guys later. This is Finding Value.